A man who lasts in this game learns one lesson sooner or later. The market does not reward hurry. It rewards patience. And patience, my friend, is nothing more than waiting for confirmation. You may think you see an opportunity. The chart begins to curl upward. Volume expands a little. The financial news starts to chatter, and your pulse quickens. You tell yourself, if I don't act now, I'll miss it. But tell me, how many times has that urgency cost you money? How often has anticipation robbed you where confirmation would have paid you? In my time, I learned that anticipation is the most expensive habit a trader can afford. The tape does not owe you an early entry. The chart does not reward your eagerness. Price must prove itself. Until it does, you are merely guessing. And guessing is not speculation. It is gambling. The market speaks in price and volume. That is its language. When a stock breaks out of a well-formed base on convincing volume, that is not hope. That is evidence. When it clears resistance and holds above it, that is not opinion. That is confirmation. Why should you risk your capital before the evidence appears? Is your money so plentiful that you can afford to be early and wrong? Many traders believe the fortune lies in catching the very bottom or selling the very top. They want to boast that they bought at the lowest tick. I have seen that desire ruin more accounts than bad luck ever did. The real money is not made in the first eighth of a move. It is made in the heart of the move, after the trend has declared itself. Do you see the difference? When a stock emerges from a long consolidation, rallies, pulls back lightly, and then pushes higher again. That second push is your signal. That is the market telling you demand is real. The weak hands have sold. The sellers have tested the ground. The buyers remain. That is confirmation. And confirmation is your ally. The impatient trader buys the first breakout without waiting to see if it holds. The disciplined trader waits for the close above resistance. He waits for the retest. He waits for the higher low. He lets the market prove strength. Which one do you suppose survives the year? You must train yourself to sit still. Sitting is harder than trading. The ticker will tempt you. Every small fluctuation will whisper opportunity, but not every movement is meaningful. The market spends most of its time preparing for a move, not making one. If you act during preparation, you become part of the noise. Have you noticed how often a stock appears strong in the morning, only to fade by the close? That is why confirmation matters. The close is truth. The intraday excitement is merely suggestion. Wait for the close. Wait for the follow-through. Let the day finish its story before you write your check. There is also confirmation in failure. When a stock attempts to break out and cannot hold above resistance, that is information. When it falls back into its range on heavy volume, that is not random. It is the market telling you demand was insufficient. Why argue with that? Why cling to hope when the evidence contradicts you? Confirmation protects not only your entries but your exits. If a stock breaks below a key level on strong volume, that is confirmation of weakness. Do you need a second warning? Do you require a committee meeting to tell you the tide has turned? The chart has already spoken. I have always believed that the big money is made by aligning oneself with the primary trend. But how do you identify that trend? You do not guess it. You observe it. Higher highs and higher lows confirm an uptrend. Lower highs and lower lows confirm a downtrend. It is simple. Not easy, but simple. When the general market confirms strength, indexes breaking out, leadership stocks advancing, volume expanding, that is when you press your advantage. When the market confirms weakness, distribution days piling up, leaders breaking down, that is when you grow defensive. The tape leaves footprints. Your job is to follow them, not to predict where they will appear next. And let us speak plainly about capital. Your trading account is your inventory. It is your business. No merchant would empty his shelves on a rumor. No banker would lend without collateral. Yet traders risk their entire stake on a hunch. Why? Because they lack the discipline to wait. Waiting is not passive. Waiting is strategic. While others are trading every wiggle, you are studying structure. You are marking support and resistance. You are watching volume signatures. You are observing how a stock behaves at critical levels. Does it rebound quickly? Does it hesitate? Does it collapse? That behavior is the market's character. and character reveals itself over time. Do you want to build wealth in the market? Then think in campaigns, not impulses. A campaign begins only after confirmation. You enter when the probability shifts in your favor. You add only when the position proves itself. You pyramid into strength, not into weakness. And you never average down in the absence of renewed confirmation. There is a great comfort in waiting for proof. It removes emotion. It removes argument. If the stock does what it must do, you act. If it does not, you stand aside. The market makes the decision for you. You merely execute. Some will say, but if I wait, I'll miss part of the move. Perhaps you will. But you will also miss many false starts. Which do you think costs more over a lifetime of trading? Missing a small portion of a genuine trend, or repeatedly entering premature breakouts that fail? The seasoned trader understands that survival precedes profit. Confirmation is a tool of survival. It keeps you aligned with strength and away from weakness. It keeps you from fighting the tape. And fighting the tape is a battle you will never win. Train yourself, then, to pause before every trade and ask, what is the confirmation? Is there a breakout with volume? Is there a trend in place? Has resistance been clearly overcome? Has support held under pressure? If the answers are vague, your trade should be vague as well, meaning you should not take it. Your patience today is the foundation of your capital tomorrow. Every dollar preserved by waiting for confirmation is a dollar available for the true opportunity when it comes. And it will come. The market always provides another chance for the prepared mind, but it does not reward the restless one. So when you next feel that urge to anticipate, to jump ahead of the signal, to act before the proof appears, stop and consider what the tape has actually confirmed. The market pays for proof, not for prediction. That is a lesson a trader learns either by study or by loss, and most men seem to prefer the latter. I have seen bright minds, educated men with figures and formulas, all trying to outguess the tape. They wanted to be first. They wanted to say, I knew it before it happened. But the market does not reward pride. It rewards patience. Prediction is a tempting habit. You look at a chart and you begin to imagine what should happen. The stock has declined for weeks. Surely it must rally. The company has good news. Surely buyers will rush in. The market has risen too far. Surely it must fall. But tell me, how often does surely put money in your account? The market does not move because something should happen. It moves because buyers or sellers prove themselves in price. Proof appears in action. It shows up in higher highs and higher lows. It shows up in heavy volume pushing price through resistance. It shows up in a stock refusing to decline when the general market weakens. That is proof. That is the only language that matters. Everything else is opinion, and opinions are cheap in this business. The amateur tries to predict turning points. He wants the glory of calling the bottom tick. He studies oscillators and whispers of insider activity. He reads headlines and listens for rumors. But the professional waits. He waits for the stock to stop falling and begin rising. He waits for accumulation to reveal itself. He waits for the sellers to exhaust themselves. Why? Because he understands that the money is made in the move, not in the guess. Have you ever noticed how often a stock appears ready to reverse, only to fall further? That is what prediction costs you. You anticipate a bottom, you buy, and the market proves you wrong. Then you buy again, and it proves you wrong again. Soon your capital is tied up in hope instead of opportunity. Had you waited for proof, a break of the downtrend line, a surge in volume, a series of higher closes, you would have risked less and gained more confidence. The same is true on the short side. Many traders attempt to predict tops. They say a stock has risen too far, too fast. They believe it is overvalued. They sell short because it feels logical. But logic is not proof. A stock can remain overvalued far longer than you can remain solvent. The proof of weakness comes only when price breaks support, when rallies fail to make new highs, when distribution days appear in clusters. That is when you act, not before. There is a calmness that comes from waiting for proof. When you trade on prediction, you feel tension. You watch every tick. You question every fluctuation. But when you trade on confirmation, you have evidence on your side. The market has already shown its hand. You are not guessing the future. You are responding to the present. Consider the breakout from a sound base. Many traders anticipate it. They buy while the stock is still beneath resistance, hoping to catch the move early. But resistance exists for a reason. It marks a level where sellers previously overwhelmed buyers. Until price proves it can overcome that supply, there is no edge. When the stock finally pushes through on strong volume and closes above that level, that is proof. That is demand overcoming supply. That is the moment probability shifts. Do you see how different that feels? You are not hoping for strength, you are witnessing it. You are not predicting that institutions will step in, you see their footprints in the volume. The risk becomes defined. If the breakout fails and falls back below resistance, you exit. The market has invalidated the proof. Your loss is small because your entry was disciplined. Prediction, on the other hand, often leads to stubbornness. When you guess and the market moves against you, you cling to your opinion. You search for reasons to justify your position. You read more news, consult more indicators, ask more friends. You become invested in being right instead of being profitable. Proof frees you from that trap. The chart either confirms your thesis or it does not. There is no argument. Wealth in trading is not built on brilliance. It is built on consistency. And consistency comes from following rules rooted in evidence. If you require proof before committing capital, you eliminate many low-quality trades. You avoid choppy markets. You sidestep false breakouts. You preserve energy and funds for the moments when the odds are clearly in your favor. Ask yourself before every trade, what has the market proven? Has it demonstrated strength with sustained buying? Has it shown weakness with persistent selling? Or are you merely projecting your expectations onto the chart? If the answer is the latter, you are not trading. You are speculating without foundation. The tape does not care about your forecasts. It does not reward your cleverness. It responds only to supply and demand. When demand is stronger, price rises. When supply is stronger, price falls. Your task is not to foresee which force will win tomorrow. Your task is to observe which force is winning now. This approach requires humility. You must accept that you cannot know the future. You must accept that waiting for proof may cause you to miss the first portion of a move. But missing the first portion is a small price compared to entering a move that never materializes. The steady accumulation of small, controlled gains builds far more wealth than the occasional dramatic guess. Over time, you will notice something. When you demand proof, your trades become fewer but stronger. Your confidence grows because it rests on observable facts. Your drawdowns shrink because you are no longer fighting unconfirmed ideas, and your mindset shifts from chasing action to selecting opportunity. The market pays for proof, not for prediction. It pays the trader who aligns himself with demonstrated strength and steps aside from unproven assumptions. It rewards the one who studies behavior instead of inventing scenarios. And each day it offers the same quiet question to every participant willing to risk capital. A breakout is not real until it holds and closes strong. That is not a slogan. It is a safeguard. Many fortunes have been bruised by breakouts that looked convincing at noon and disappointing by the bell. The market has a habit of testing conviction, and nowhere is that more evident than at the point of resistance. You see a stock approach a level where it has failed before. It nudges above it in the morning. The tape grows lively. Volume begins to expand. The impatient trader feels the pull. This is it, he says. If I wait, I'll miss the move. But tell me, how many times has that early excitement faded by the close? How often has price slipped back below resistance, leaving only regret behind? Resistance is memory. It is the price at which sellers previously overwhelmed buyers. When price returns to that level, those sellers often reappear. Some want to exit at break-even. Others see an opportunity to sell again. If the demand is not strong enough to absorb that supply, the breakout will fail. That is why the close matters. The close is where the day's battle is settled. A breakout that holds into the close shows persistence. It shows that buyers did not retreat at the first sign of pressure. It shows that institutions, those with real capital, were willing to carry positions overnight. Do you think professionals commit serious money for a move they do not believe in? The close is their signature. Intraday strength can be misleading. Algorithms push price. News headlines spark bursts of activity. Retail traders pile in at the first sign of motion, but by afternoon, reality sets in. Sellers lean on the stock. Volume shifts. If the price cannot maintain its ground, the breakout was never genuine. It was enthusiasm without endurance. There is another detail that separates the true breakout from the false one: volume. A strong close above resistance accompanied by meaningful volume is evidence of demand, not just casual buying, but determined accumulation. When price breaks out on thin volume, caution is warranted. Who is doing the buying? Is it broad participation or merely a temporary imbalance? The disciplined trader waits for confirmation. He watches how the stock behaves after crossing resistance. Does it surge and then stall? Does it retreat sharply on the first pullback? Or does it remain firm, consolidating tightly above the breakout level? Strength tends to hold its gains. Weakness gives them back quickly. Have you noticed how often a stock will poke above resistance for a few hours, attract eager buyers, and then reverse hard? That reversal is not random. It is supply overpowering demand. It is the market telling you the breakout was premature. If you bought on anticipation, you are now trapped. If you waited for the close, you avoided the trap altogether. A proper breakout does not need drama. It may move steadily rather than explosively. It may pause slightly near the highs. What matters is that it finishes strong. The final print of the day reflects conviction. The market has had hours to reconsider, to test the level, to challenge the move. If price still stands above resistance at the close, that is meaningful. Some traders fear missing the early part of the move. They say waiting for the close costs them a better entry. Perhaps it does by a small margin. But what is the cost of entering a false breakout? A small advantage in price means little if the move collapses the next day. Preservation of capital is superior to precision of entry, and consider the follow-through. A real breakout often continues the next day or after a brief, shallow pullback. A false one struggles immediately. If the stock cannot build upon its breakout, that weakness is a warning. The market rarely hides its intentions, it simply requires patience to observe them. You must train your eye to recognize behavior around key levels. Watch how price reacts to resistance. Does volume expand as it approaches? Does it accelerate through the level, or does it hesitate? After crossing, does it stay above with tight trading ranges? These are signs of strength. Wide, erratic swings and swift reversals are signs of instability. The broader market also plays its part. A breakout attempted in a weak general market faces headwinds. Even strong stocks can falter if the tide is against them. When indexes confirm strength, when they too break above resistance and close firmly, the probability of individual breakouts succeeding increases. Alignment matters. There is a certain patience required to wait for the bell. The last hour can feel long when price hovers near resistance. You may feel the urge to act before confirmation appears, but discipline in that hour can spare you days of frustration. Let the market prove it can sustain the breakout under pressure. A breakout that holds and closes strong gives you a clear line in the sand. The old resistance becomes potential support. If price falls back below that level on convincing volume, you have your signal to exit. The risk is defined. The structure is clear. That clarity is a trader's ally. Contrast that with buying before confirmation. Where is your line? What level invalidates your trade? Without a strong close, resistance has not truly been conquered. Your position rests on hope rather than evidence, and hope is not a strategy. Over time, you will see that many so-called breakouts are merely probes. The market tests higher prices to see if demand exists. If it does not, price retreats. Only when demand absorbs supply and maintains control into the close does the breakout become real. That is when probability begins to favor continuation. This approach will not place you in every move. It will not catch every spike. But it will keep you aligned with strength and out of many traps. And in trading, avoiding traps is as important as finding opportunity. So the next time you see price cross above resistance during the heat of the session, pause. Ask yourself, has it held? Has it closed strong? Has volume confirmed the move? Or am I reacting to excitement rather than evidence? Volume is the jury. Price alone is only the witness. A witness may speak loudly, but without a jury to confirm the testimony, there is no verdict. In the market, price makes the statement. Volume decides whether that statement carries weight. Too many traders listen to the witness and ignore the jury. You see a stock rise 2 or 3% in a day. The chart shows a clean upward bar. It looks impressive. But how many shares changed hands? Was the move supported by heavy participation, or did it drift higher on light trading? If only a handful of participants pushed the price, can you trust the move to continue? Without volume, price is merely an opinion expressed by a few. Strong trends are built on commitment. Commitment reveals itself in volume. When institutions accumulate shares they cannot hide, their orders are too large. They leave footprints. Those footprints appear as expanding volume accompanying decisive price movement. That is the jury delivering a clear verdict in favor of strength. Have you ever bought a stock because it looked strong, only to watch it stall the next day? Look back at the volume. Was it convincing? Or was the move thin and fragile? Thin moves often reverse because there was no broad agreement behind them. The market may have nudged upward, but the majority was not persuaded. Consider a breakout above resistance. Price pushes through a well-defined level. The chart looks clean. But if volume remains average or below average, caution is warranted. Why would a genuine shift in supply and demand occur without increased participation? If a new uptrend is beginning, buyers should be eager. They should step forward in size. When they do not, the breakout may lack conviction. Volume confirms urgency. When traders believe an opportunity is meaningful, they act decisively. They do not wait. They compete. That competition shows in the number of shares traded. Heavy volume on a breakout suggests urgency to own. Heavy volume on a breakdown suggests urgency to sell. In both cases, the jury is speaking clearly. But volume must be interpreted in context. Heavy volume alone is not automatically bullish or bearish. A stock may decline sharply on high volume, that is distribution. It may rally strongly on high volume, that is accumulation. The key is the relationship between price and volume. Are they aligned? Does rising price come with expanding volume? Does falling price come with swelling turnover? Alignment tells the story. Ask yourself who is participating. Retail traders cannot generate the kind of volume that sustains major trends. Institutions, mutual funds, hedge funds, pension managers are the real force. When they build positions, it takes time and size. That activity appears in persistent above average volume during advances. When they exit, distribution days appear, sharp declines with heavy turnover. You may notice a stock climbing steadily on declining volume. At first glance, it seems healthy. Price is rising, but the jury is growing silent. Participation is shrinking. Such advances can be vulnerable. Without fresh demand, the move may run out of fuel. A single surge of selling can tip the balance. Likewise, during corrections within an uptrend, watch the volume. If price pulls back on light volume, it suggests sellers are not aggressive. The decline lacks conviction. That is constructive. But if price falls on heavy volume, that signals stronger distribution. The jury may be shifting its stance. Volume also exposes false strength. A stock may rally into resistance on weak volume, only to reverse sharply when confronted by supply. The initial rise was not supported by widespread buying. It was an advance without backing. The reversal, often on increased volume, reveals the true sentiment. Do you study volume with the same attention you give price? Or do you treat it as an afterthought? Many traders focus on patterns and indicators while neglecting the most direct measure of participation. Price patterns without volume analysis are incomplete. They lack confirmation. In prolonged consolidations, volume often contracts. That is normal. The market is resting. Supply and demand are in temporary balance. But when the stock finally resolves that balance, either upward or downward, volume should expand. Expansion indicates that a new consensus is forming. Without that expansion, the move may lack durability. There is also a rhythm to volume. During healthy uptrends, you will often see volume expand on up days and contract on down days. That pattern suggests buyers are more aggressive than sellers. In unhealthy trends, the opposite occurs. Volume swells on declines and shrinks on rallies. The jury is leaning toward weakness. Volume precedes headlines. It reflects action before explanation. You may not know why a stock is moving, but if volume surges alongside price, something significant is occurring. The market often senses change before the public does. By observing volume, you align yourself with that awareness. But do not become mechanical. Volume spikes can occur due to news events, earnings releases, or rebalancing. Context matters. Is the volume spike accompanied by a decisive break of a key level? Does price close near the high of the day, or does it reverse sharply after the surge? The jury's decision is not merely in the number of shares traded, but in how price responds to that activity. When you review your trades, examine the volume at entry. Did the move have institutional sponsorship, or did you rely on price alone? If you consistently demand that volume confirm your trades, you will filter out many weak setups. Your positions will be supported by participation rather than hope. The market is a voting machine in the short term. Each share traded is a vote. Volume counts those votes. Price reports the result. Without the vote count, the result is suspect. A narrow victory can be overturned. A landslide is harder to challenge, so when you see price move, do not ask only how far. Ask how many stood behind it. Was the jury active and decisive? Or was the witness speaking without support? The close tells the truth. Intraday noise tells stories. I have watched the tape long enough to know that the market can be theatrical during the day. It can surge in the morning, stumble at noon, and recover by afternoon. It can frighten the timid and excite the reckless, all before the final bell. But when the session ends, when the dust settles, the closing price is the verdict. During market hours, emotion runs high, news crosses the wires, rumors circulate, traders react instantly. Price jumps and dips in quick succession. It feels urgent. It feels important. But tell me, how many of those movements still matter once the market closes? How many midday panics are forgotten by evening? The close represents commitment. It shows where buyers and sellers were willing to hold positions overnight. That decision carries weight. Anyone can act on impulse for a few minutes. It takes conviction to carry risk beyond the session. The closing print reflects that conviction. Consider a stock that breaks above resistance early in the day. The chart looks strong at 10:30 in the morning. Volume is brisk. Commentators begin to speak of a breakout, but by the final hour, sellers appear. The price drifts back below resistance and closes weak. Was there truly a breakout? The intraday chart may have told a hopeful story, but the close delivered the truth. Many traders are shaken out of sound positions because they react to intraday swings. A stock pulls back sharply in the morning, and fear takes hold. They sell, only to watch it recover by the close. Why? Because they allowed noise to dictate their action. The broader trend had not changed. Only temporary emotion had surfaced. The market tests resolve during the day. It probes both sides. It seeks liquidity. Quick spikes up or down often serve to trigger stops and stir emotion. If you allow every fluctuation to influence your judgment, you will trade frequently and inconsistently. But if you wait for the close, you give the market time to reveal its true direction. Have you noticed how often strong stocks close near their highs? That is not an accident. When demand is persistent, buyers step in even late in the day. They are not afraid to hold overnight. They press their advantage into the bell. Conversely, weak stocks often close near their lows. Sellers remain in control until the session ends. That is information you can trust more than any midday rally or dip. The close also defines structure. Support and resistance levels are confirmed by closing prices, not fleeting intraday extremes. A stock may briefly trade below support, only to recover and close above it. Was support truly broken? The intraday low suggests weakness, but the close suggests defense. Which carries more significance? Professional traders understand this distinction. They may observe intraday movements, but they respect the close. They analyze end-of-day charts. They study where the market settled, not merely where it wandered. They know that closing strength or weakness influences the next session's psychology. Intraday noise often tempts traders into overtrading. A sudden spike appears, and they chase it. A quick drop occurs, and they panic. Transaction costs mount. Emotional fatigue increases. Yet the broader trend may remain intact throughout. By focusing on the close, you reduce impulsive decisions and align yourself with more meaningful signals. This does not mean intraday data has no value. It can reveal short-term momentum and areas of interest. But without confirmation at the close, it remains provisional. Think of it as a draft rather than the final manuscript. Only when the session ends does the market finalize its statement. There is a psychological advantage to waiting for the close. It enforces discipline. It prevents snap judgments. It allows you to evaluate the day as a whole rather than reacting to fragments. When you review charts after the bell, emotion has subsided. You can assess strength and weakness with greater clarity. Imagine a day when the market opens sharply lower on alarming news. Fear spreads quickly. Prices drop hard in the first hour. Many traders sell in haste. But as the day progresses, buyers gradually absorb the selling. By the close, the indexes finish near unchanged or even positive. What does that tell you? It tells you the initial panic was noise. The close revealed resilience. The reverse can also occur. A market may rally strongly in the morning, fueled by optimism. Traders celebrate. Yet by afternoon, selling pressure builds. Gains evaporate.